Hi, everyone. Welcome to our February 8th, 2021 virtual Kiwanis Club meeting. Wondering if a lot of people stayed up late watching that Super Bowl last night. We have a light crowd, but here are some more people coming into the meeting. So as always, we're going to begin with our Pledge of Allegiance. Angela says she's eating her lunch, so she's going to show her video shortly. So we're going to begin with our Pledge of Allegiance. I'm going to step out of the way so we can see the flag. If everyone will unmute their microphones, we can do that and we can have our Pledge of Allegiance. Okay. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Okay, so a couple announcements that I want to make sure everyone is aware of. We have our first ever virtual interclub meeting with the Indianapolis Kiwanis Club on March 22nd. Tom Robertson has agreed to share a brief history of our club at this special meeting. And we really want to do a program on the Master Tournament and/or Augusta National. So if anyone has any ideas for speakers, reach out to our President-elect Troy Lanier with your ideas for that. Also want to make sure everyone's aware that the Division 6 rally is tomorrow night. Jeff Drake, our Lieutenant Governor, invites everyone in the club who wants to come. It's at 7:30. Lowell and I will be there representing the club, but if there are any other members who would like to join us, we would certainly welcome you. If you have, plans for something fun to do, this might top it. Anyway, if you want the link, I sent it out Friday, but if you need it again, you can email me and I'll be happy to share that with you. Just an update on the Sam Tyson Scholarship Fund. We are still collecting. We're getting close to that $25,000, but we're not there yet. So if you want to donate to that, you can send donations directly to the Community Foundation, and we have that address in the notes. So now I want to begin with our history lesson, and I'm actually very excited about our history lesson because I think I picked a good one for the topic, or maybe Troy just knew perfectly the speakers to schedule for this day. So the NASDAQ stock market was created by the National Association of Security Dealers to enable investors to trade securities on a computerized and speedy, transparent system. The NASDAQ's first trading day was February 8th, 1971. The main indexes that track the NASDAQ performance are the NASDAQ Composite, an index of more than 3,000 stocks listed on the NASDAQ exchange that includes the world's foremost technology and biotech giants like Apple, Google, Microsoft, Oracle, Amazon, and Intel. And then there is the NASDAQ 100, although there are smaller indexes that track different parts of the market's performance as well. The NASDAQ was created by the National Association of Security Dealers to build the first all-electronic stock exchange in 1971. So unlike other exchanges, most notably the New York Stock Exchange, there is no physical trading floor for the NASDAQ. All of its stocks are traded electronically through an automated network of computers, and this was its mission from the beginning. Initially, NASDAQ did not facilitate trades, but rather just gave automatic quotes. However, after a few years, NASDAQ began over-the-counter trading. The exchange grew with companies like Oracle and Dell and has now expanded into today's tech giants. The NASDAQ attracts some of the largest blue chip companies in the world. Because it does attract these growth-oriented companies, its stocks tend to be more volatile than other exchanges. It has long been an industry leader in innovation, Again, it was the first to have an all electronic trade as opposed to the New York Stock Exchange's physical floor. It also created the NASDAQ 100 in 1985. It was the first to launch a website, NASDAQ.com, in 1996. And it is now the first exchange to have used the cloud to store data. So today is the 50th birthday of the NASDAQ. So Troy perfectly lined up speakers to celebrate the 50th birthday of NASDAQ. Now we are going to do our attendance prize, which if you remember, it's a $15 gift certificate to Toast Wine and Beverage. And as always, want to thank Mark Alberton for helping coordinate that. So if you win, he will be the one sending you your gift certificate to pick out the beverage of your choice. So Hamp, if you could give me a number between 1 and 21.
Sure, Martha. I'm going to choose 17.
Okay. That is Brian Graham. Congratulations, Brian. You have won our Toast Wine and Beverage gift certificate. I'm certain you will put it to good use.
It will most certainly be put to good use. Thank you very much.
Okay, great. Thanks, Brian. Now I'm going to turn over the program to our president-elect, Troy Lanier, who will introduce our speakers. Troy?
Two speakers today are a current member and a former member. Hamp Manning is a former member of our club. He's a native of Augusta. He's a graduate of Richmond Academy and Georgia Tech. He has been in the wealth management industry since 2012. He started at Merrill Lynch and he is now at Asset Advisors Investment Management. Asset Advisors provides personal wealth management and discretionary investment management services to high net worth individuals, charitable organizations, pensions, and profit sharing plans and corporations. And he is joined by current member Chuck Lanier. Everybody's familiar with Chuck. A little bit about Chuck's history. He's a 1971 graduate of the University of Georgia with a degree in finance. He was in active service at Fort Gordon for 3 years, and he served from 1975 to 2001 in the Army Reserves, retiring as a colonel of military intelligence. He received his MBA in 1979 from Augusta College, and he worked from 1975 to 1985 at Citizens and Southern National Bank, where he served as a vice president in the trust department. And in 1985, he changed from banking over to financial planning. He's a certified financial planner from 2008 until the present date. He has been associated with Fuller Frost Lanier Wealth Management, and he is president of that company. And he is a proud former president of our club. And we're looking forward to what both Chuck and Hamp are going to tell us about retirement planning.
Okay, thank you very much, Troy. Hamp and I are pleased to be able to make this presentation today. We're going to sort of have a back and forth here. Maybe the place to start would be with a definition of retirement. Basically, retirement is having enough assets so a person no longer needs to work. So that could happen at age 52. It could happen at never. But it's more than just the financial part. There's a sort of a psychological part to it, and it is people really need to have something to retire to. I mean, they have to either have hobbies or want to continue to work for some sort of charitable organization as a volunteer, or play a lot of golf or do something, but it's not mentally healthy to not have something to get up to every day. Hamp, what do you think about retirement?
Yeah, so I'll tag on to the psychological standpoint. And an interesting thing about this past year, 2020, and even into 2021, is these COVID lockdowns and being stuck at home have given a lot of people a glimpse of what retirement may look like. And you know, we certainly have plenty of clients and family members, who'll tell you that they've failed at retirement. They've put in their time, put in their years, and that they just really don't know what to do. So Chuck raises a very good point. You've got to think about, what you're going to do when you stop working. Another thing I'll mention is, we want to try to bring you, the participants, the viewers, a divergence of opinions. I'm relatively young in the wealth management industry. Chuck is long tenured. And so we will have some different opinions, but we're very much aligned in a lot of what we're going to talk about today. But going back to the definition of retirement, I think that's really just the point at which your passive income exceeds your active income. And so in that essence, you can retire. And it also speaks to the definition of what wealth is. And wealth, I believe, really isn't measured as much in terms of dollars as it is in time. And so if you have, say $1 million set aside, to the person who spends $40,000 or $50,000 a year, then, you are wealthy because that will allow you to live a number of years comfortably. But for the person who needs $100,000 or $200,000 a year to live on, $1 million nest egg really doesn't last you that long. And so in that vein, I'll share a story. You may be familiar with the anecdote, the advisor and his client living up in New York City, an area with a very high standard of living. And the client comes to the advisor and asks, I've worked all these years, I've saved all this money. Am I ready to retire? And the advisor says, well, yes and no. No, not in New York City, not with what you've saved and with the standard of living and the high expenses, but you can, say, for example, go to Augusta, Georgia and retire very comfortably. Or, at the very opposite end of the spectrum, you could sell all of your assets and, live like a monk in Tibet with a very low standard of living. And so that just gives you a sense of what that means.
Yeah, it really depends on what you expect out of your retirement. 80 years ago, when they put together Social Security, it was routine for people to retire at 65 and die at 68. Not everybody, of course, but I mean, a lot of people didn't live so long. And when they established Social Security, they did it based on 3-year retirements. Well, of course, these days we have people retiring and living 20 and 30 years into retirement. My dad retired at 52 and my mother died just a few weeks ago at 96. So she had a 40-year retirement. So it can go on and on. You have to prepare for the eventuality that you might or your spouse might be here a long time.
So, I'd like to give some examples of what some, prominent figures in the industry think about retirement and just wealth accumulation in general. We all know who Warren Buffett is, I think. And, we can all consider him to be a very reputable source when it comes to this kind of, material. And we know that he's a very long-term thinker. He's a big picture thinker. And he's been very vocal about, not concerning himself with the minutia of market movements and price action. And he said many times before that he would prefer there not to be a New York Stock Exchange, not in the sense of trading stocks back and forth, but in just monitoring the prices. But going to speaking of his long-term investment horizon, investment is not a short-term activity. That would be called speculation, which Chuck will speak to in a few minutes here. But looking at the long-term growth, compound interest, I've always thought is the 8th or 9th wonder of the world, so to speak. And Warren Buffett will often talk about his $25,000 haircut, and what that means is if you go and you spend 20 or 30 or I don't know $50 on a haircut today, well, if you would instead invest that money for a number of years, say 30 or 40 years at an 8 or 10% rate of return, that will then become $20,000, $30,000, a very long time from now. And so, it's not about the time. You're not trying to time the market. It's all about the time in the market. And it's just that long-term view that investors should be most concerned with.
Yeah, too many people get started too late. And, somebody comes to me at age 63 and wants to retire at 65. And I ask, well, what have you done up to this point? And they say, well, nothing, I'm ready to get started. they're not going to be able to retire at 65 unless they have a very low income need there, which kind of brings up the idea of the time period that we accumulate assets that we're going to use for retirement is a time period we call the accumulation period. And it really starts whenever you start working, whether you're doing it or not. That's your accumulation period start time. And it goes up to the point that you actually pull the trigger and say, okay, I'm ready to retire. At that point, you enter into a different period, which is called distribution planning. And in the accumulation phase, you can make mistakes and recover from those. You can invest in some wrong things and try to get back on track. But the market is much less forgiving when you're in the distribution phase, because in distributing your assets, if the market's down and you have to have money from your investment portfolio, you're selling low. So we have to be very careful in designing retirement plans. One of the things we use for planning for a portfolio is allocation. It's sort of a cousin to diversification. Allocation is where somebody has to make a decision on what am I going to invest in. There are different categories. I think I'll let Hamp talk first about, say, the first three of these categories.
Sure. So we're all familiar with your basic stocks, bonds, and cash allocation. And I think there's a common misconception that people will spend way too much time concerning themselves. Well, do I buy Coke or do I buy Pepsi? Do I want to own AT&T or Verizon? And really, the truth is the vast majority of your returns are determined by your overall allocation, which is, am I 50% stocks or am I 70% stocks? And the remainder being cash, fixed income, real estate, which Chuck will mention in a second. And so, my advice would just be, don't worry about the individual securities. Again, Warren Buffett, he's always said, just buy the S&P 500 index fund, very broad, diversified investment, low cost, and leave the stock picking, to the professionals like Chuck and our firm. When it comes to equities specifically, there's growth and there's value. And at some point, when you transition from the accumulation phase to the distribution phase, you'll have to replace your income. So how do you do that? And dividend paying stocks generally play a large role in replacing that income. One thing that our firm really values greatly is not necessarily current yield, a high current yield, but we want to see companies that have strong balance sheets and that can grow their dividend very consistently over a number of years. And to go back to the AT&T example, that can be, that's a fine company, and I'm certainly not making any blanket recommendations and just using it as an example. But AT&T yields 6 or 7%, but it's only growing that dividend at, say, 2% a year, and that's over the last 5 or 6 years. In contrast, I can think of an industrial company, Cintas, may be familiar with. They handle uniform rentals and such, and they grow their dividend by about 25% a year over the past 5 years. And so that's remarkable growth, but they're only yielding 0.9%. And so, really we're more concerned with the growth of the dividend than the current yield. But either way, if you adhere to that approach, you're going to give yourself a growing stream of income during your retirement years that should keep up with inflation. And one last thing I'll say before I pass it back off to Chuck is, the last couple of years have been very interesting with overall portfolio management because of the low interest rate environment. And so traditionally your 60-40 allocation, 60% stocks, 40% bonds, we've kind of had to rethink that because the returns just aren't there in bonds. There's a 0% interest rate environment, but they're still very important to the overall allocation, and I can expand, or Chuck can expand. But one thing that's interesting too, this driving stock market returns, we think, is the bond market is so much larger than the stock market, and not a lot of people understand that. But you've got these massive quantities of dollars that have to generate some return, and those are flowing from bonds to stocks because you've either got a 0% bond or a 0.1% dividend yield on a stock or an AT&T that yields 6%. And so in that essence, the stock market is what we call a TINA market, TINA being an acronym for there is no alternative to stocks. And that's been a big tailwind for us, we think.
So your first three categories in asset allocation would be cash and then bonds and stock. And, some people think, well, I'm going to pick one or the other. Whereas with asset allocation, what you're trying to do is get the right blend of everything. Well, the other two categories that typically we use are investment real estate and then other. And other is a basket that includes gold and silver and pork bellies and everything else you can find out there. I know that some people listening today probably own a duplex or an extra house, or not a place that you use, but that you rent out. But there are people who don't want to be bothered with the idea of renting out or having to recover from a tenant who tore up a place. So some people will invest in real estate investment trusts. There you have professional management. They're a little bit on the expensive side. A wise person once told me, don't be so overly concerned with the cost that you overlook what you're going to gain. So, you do have to be careful, though. Hamp, talk a little bit about the history of the market.
Sure. So we talked about it's important to own real estate and fixed income and stocks to take you from the accumulation phase to the distribution phase. And historically, stocks have generated a very fine return. Looking at the S&P's generated over 10% going back a number of decades. But you have to keep in mind the volatility there. And before you can achieve your 10% average annual rate of return, you have to live through the drawdowns and the corrections, and that's just a normal part of the cycle. So just to look at a couple of numbers, this is going back to 1920. Every three times a year, we can expect a 5% pullback. Every 16 months or about a year and a half, you can expect a 10% pullback. And then a 20% or more correction occurs once about every 7 years. And I'm sure a lot of us are still licking our wounds from about this time last year, March. The market was down as low as 35%, I think, off the highs. And that's just, the price of admission that you pay when you own stocks. That's, it's normal for markets to go down. It's kind of like asking the weatherman, well, when is it going to rain? Well, the answer isn't as much as when it's going to rain, but when it does rain or when it does hurricane, are you still going to, is your house still going to be standing? And that's the job of the advisor, to construct a portfolio of quality companies or otherwise quality investments that will withstand the corrections and will recover.
The fact that some companies go out of business from time to time is sort of a given. That's one reason we have to be not only allocated into different stovepipes of investments, whether it's cash or bonds or stocks or real estate, but we also have to be very diversified. In other words, to have a lot of stocks. What we try to educate our clients on is the fact that the market has never gone down from which it didn't have a 100% recovery. It's never happened. I do know people who, in the bubble that burst in 2000, from the big run-up of the 1990s, some people lost an awful lot of money. Well, the way they lost the money was, let's just say somebody inherited $100,000 and wanted to diversify, so they bought 10 different .com stocks. Well, that's not diversification. That's they bought .com stocks, but they didn't buy all the other great companies that are out there. So when the .coms got in trouble, they lost the money. So we would not call that investing. We would call that speculating. Speculation is where you think something is going to happen and you put your chips on that number, so to speak. You say, I think the market's going to do a certain thing and certain companies will benefit. I'm going to try to buy those companies. Well, that's speculation. It doesn't mean you shouldn't try to own some of those companies, but maybe own some of those companies in addition to 500 or 1,000 others. The options you have to pick from are large U.S. companies and small U.S. companies, and large companies internationally and small companies internationally. There are huge numbers of options. It's much better to invest, as Hamp says, sort of ride the ups and downs, because the ups are always better than the downs. And when you get to the end of the ride, you'll be okay. Somebody once explained it like riding an escalator from the first floor to the second floor, and then yo-yoing on your way up as the escalator moves. Well, the yo-yo is the stock market going up and down, but when you get to the second floor, you're a floor higher. The market might have gone up and down many, many times along the way, but at the end of the time period, whether it's 2 years or 50 years, you're going to be better off to have done proper investing. Hamp, how would you go about creating an income from an investment portfolio?
Sure. So what that means from portfolio construction standpoint, we discussed that fixed income serves and cash serve an important place in the portfolio, even though they're yielding very low. But we talked about how people can become fixated on the portfolio value and watch the price go up and down and fall. And what we would say is, the stocks, can go up, down, sideways. It doesn't matter, but you should have whatever you need to live on, your required distributions, and depending on your comfort level, whether that's a year worth or 2 or 3 years worth, or certainly no more than 10, set aside in the portfolio and not be invested in stocks. Okay, and so those are going to be your cash and fixed income, bonds, those types of investments, and they're not necessarily designed to generate a return as much as they are to be safe, and they just need to be there for you when you need them, so that when the market does go down and you still need to make your withdrawals to meet your living expenses, you're not having to sell stocks during a period of decline. And so from nothing else, that should serve as a sleep factor, knowing that you can put your head on the pillow at night and the market can tank the next day, and it's not going to affect your ability to meet your withdrawal needs this year, next year, or the year after that. Another thing I'll add about just being fixated on the total value of the portfolio, and this speaks to when you transition from accumulation to distribution, it's especially important to come back to the income that the portfolio is generating. And so in this sense, you can think of it almost as like a herd of dairy cows, and that the cows are your stocks and the milk are the dividends. And so you're only concerned with the milk. And those dairy cow, a cow could be $500 today, it could be $1,000 tomorrow. But regardless of the price, you're still going to get your milk. Now, a dairy cow farmer has an advantage, or a luxury, I guess you could say, because he can look out of his window and see all those cows out in the pasture at any time, and he knows that they're there. He's not really thinking about the prices as much. But stock investors, on the other hand, we're relinquished to the computer screen or the monthly statements, and all we see are the numbers. And we just need to get in the habit of looking at the income numbers more than the valuation numbers. And we think investors can really find a lot of comfort in that.
Thinking about that, if somebody had invested some money January 1st of 2020 and then took a long vacation and came back on December 31st of 2020 and checked their portfolio, they would see that it had an awfully nice gain for the year. They wouldn't have had any idea what happened in March and how far the market went down, and that it had such a super recovery. But in that 1 year time period, the market did fine. It just had some pretty volatile actions along the way. Thinking about how to create an income in retirement, one strategy is sort of a buckets of money strategy. And the way that works is if you have cash in the bank or credit union or money market account, wherever you have it. That's your cash bucket. And then you've got your bonds or your bond bucket. You have stocks. You might have some investment real estate, might own a little gold. You have all of these buckets of money. So when we talk to an individual, we want to know, well, how much do you feel like you need to have to live the way you want to live in retirement? And what we then do is, for example, if they say, well, we need $7,000 a month, what we do is we might carve off 7,000 times 12 months, $84,000, and take it from one of the buckets of money and put it in a cash account that's designed to simply send him into his personal checking account $7,000 every month. And about 6 or 8 months into that, we would harvest some more money out of one of his investment accounts to fill the income bucket back up. The idea being that we don't want to be forced to withdraw from an investment account that's depressed based on current market conditions. And you can do this continuously. We had a fellow about 3 weeks ago, that was his number, $7,000. And he is at a point that he can begin his Social Security and his wife's Social Security about mid-year this year. And then he had an annuity that was going to throw off a certain amount of money. And what he realized was that between the annuity and the Social Security, that was going to take care of his $7,000 a month. What that did was it made his other $2 million that he had accumulated over the years basically excess. Now, it probably won't be excess from now on. I mean, if he needs $7,000 this year, he's going to need $8,000 next year, maybe not quite that much. But with inflation, he'll need more. But the point is, we can continue to invest that $2 million somewhat aggressively because we're not concerned if it goes down. We have time to recover because his income needs are already taken care of. Not everybody's lucky enough to be in that position, but that's what we get paid to do, is to figure out how to do the distribution planning and get the most we can out of somebody's portfolio.
So that's a very good point. I love the buckets of money concept, and Chuck just described how that applies to the distribution phase for someone. But I'll just take 1 minute and talk about someone who's, maybe we have some younger listeners tuning in today, but for someone still accumulating money, it's important to think about buckets of money in terms of savings and just some broad numbers. If you're going to expect to need the same gross income in retirement as you're currently generating today, then you're going to need about 20 to 25 times your gross annual income set aside, and that's your retirement nest egg. And so for someone needing $100,000 a year, you need $2 to $2.5 million. And we can back into the numbers, and Chuck just threw out the $7,000 and that works. But what that basically means is when you've accumulated that nest egg, then you can in turn draw it down by 4 or 5% a year, knowing that the dividends and interest and market growth are going to eventually over the long term, offset those distributions. Chuck, do you have any thoughts on retirement budgeting and what people should consider?
Well, the best advice I can give would be maybe in the year or two before you retire, set up what you think would be a legitimate retirement budget. In other words, is $7,000 a month your number, or is it $4,000 a month, or is it some other number? And then set that budget up and try to live by it to see if it works. And what I would suggest is, if it doesn't work while you're still working, it's not going to work when you quit working either. So a lot of times people have to, like the guy I described, he's elated that he's in as good a shape as he's in. Unfortunately, sometimes we have people who have not done such a good job of preparing, and they realize they're going to have to curtail some of their wants and deal more with their needs. Those are unpleasant conversations, but we can probably help in many of those. But yeah, I think trying to figure out what do I need in retirement is a very important thing to do. Maybe this would be a good point to stop and see if there are any questions that we might try to handle.
Chuck and Hamp, can you hear me?
Sure.
Bob Rollins, I get a little unclear on the modeling for spending down your IRA. Let's say the minimum requirement choice you've made is on life expectancy. And let's say your annual earnings are 5% in your IRA. How do you ever spend it down?
Well,
As
it's
you get toward
dangerous.
the end. As you get
Well,
toward
it's dangerous to spend it all the way down because you may slip up and live like my mother to be 96. So it's not a good strategy to pick when you want to run out of money. I've heard people say, I want to spend my last dime the day I die. And that's kind of cute, but it's dangerous to live as if that's going to happen since we don't know when we're going to die.
Well,
unfortunately, we're going to leave some money to somebody, either family, friends, or charity.
what I'm saying though is if the choice you've made is on life expectancy, do you ever run out of the money?
Sure. So that speaks to, I think, the required minimum distributions, and that is a function of your life expectancy. But what happens is, as you get older, that percentage, that minimum distribution requirement goes up. And so when RMDs first kick in now at age 72, say it's 3.5 or 4% of your total account balance. Well, at age 80, it's something like 7%. At age 90, it's something like 10 or 12%. And so unless the account just has really strong returns, eventually your withdrawals that are forced to come out are going to exceed your returns, and you will start drawing that account down.
But most likely, you'll end up leaving some money to somebody.
So
Look, go ahead.
one more question. Then, if your life expectancy is, say 90 or something, as you get toward that, and let's say you live to be 95, it must take out almost all of it as you get to that 95, or the life expectancy figure. Is that what's being said?
I don't have that table memorized, but no, they're never taking it all, because what they do is they take increasingly larger amounts as the years pass. But you don't have to spend that money. When you take it out of an IRA, you can put it in a pay the tax on it, put it in a non-qualified account, and save it for if you live to be 102.
Thank you. I'll do that. Live to be 102.
Chuck, Hamp, I have a question. With the government spending so much money, how long do you think interest rates will stay low, and when do you think we will have massive inflation?
I'll let Hamp handle that one.
Sure. So we've got a strong tailwind here with the Federal Reserve at our back, and what Jerome Powell says, people listen to. And he said on multiple occasions that they're not even thinking about raising rates until they see inflation consistently over 2%, I believe. And so that's not going to happen in 2021, not going to happen in 2022, possibly in 2023. But their policies are certainly very accommodative for stocks. Another thing to consider too is these low interest rates when it comes to government spending. Yes, we may be at all-time highs on our national debt to GDP, but with interest rates so low, the borrowing cost is relatively low, and we're capable of withstanding that at the current rates. Now, that will change when interest rates do move up. But for right now, it's really not a catastrophic situation, we think.
I'll say that in our practice, we don't try to predict what's going to happen. We react to things that are happening. The retirement planning needs to be conservative in its approach, since we don't know what's going to happen. We'd rather be wrong on the side of erring with too much caution than otherwise. But we can't control current events or what's happening in the economy. We control our clients and their portfolios in being sure they're as well positioned as possible.
Another thing I'll add, since we have some time, that sounded almost like a political question, and I'm sure a lot of people are thinking, and it's a common trap to fall into, to think that just because your party may or may not be in power at the time, that the market's going to behave positively or negatively, and that's really the wrong way to look at it. We think, regardless of who the president is, regardless of who controls which party controls, the houses. People are going to continue to buy services from Walmart, Microsoft. People are going to go back to, Disney parks and so forth. And so really market returns have been very, agnostic in terms of who's in power politically.
Okay, who else has questions? Troy, are you trying to talk? You're muted. Okay.
Okay, just a quick question. You talked about stock picking, and I've always been interested in really who picks the stocks. So the way y'all do it, do you pick the stocks or do you pick the stock pickers?
Okay, I think we might actually operate differently. We pick the people who pick the stocks. So we pick managers to manage portfolios. So I am not a stock picker.
So we at Asset Advisors operate a little bit differently in that we are very much the stock pickers. And we manage discretionally for our clients' accounts. And so we make the buy and sell recommendations right here at our office in Augusta. This is our global headquarters. And it's not just me, Hamp Manning, making the decisions, but it's an investment committee of the other advisors in the office, George Rush and Will Rice. And we review the broad portfolio weekly, and of course individual client accounts daily. And we also provide our management services to other brokers in town, I guess you could say, and we'll manage some of their assets for other clients that are not domiciled here at Asset Advisors.
I have a question. Chuck, I know you said you guys don't try to predict the future, you react to, what's happened. But I was wondering if you guys had any thoughts about whether you'll see any reforms or anything out of the GameStop scenario that happened with the short selling and the squeeze, or I'm not getting my lingo right, but sort of the flooding of the market with just your average seller on Robinhood, and if you think that was just a blip, or if you think that there's actually going to be some sort of response to that.
Tell you what, I'm going to let Hamp answer that one. And this kind of goes along the lines of our picking the pickers. We view our goal as managing client relationships and hiring people to do the picking. And I do not consider myself an investment specialist. I consider myself a wealth planning specialist, but I think Hamp does do that. So I'll let him take it from there.
Sure. Thanks, Chuck. The GameStop, AMC, BlackBerry story was really interesting over the last week, after the last month. And what we saw there were highly shorted stocks that just had a lot of long interest in it. And the interest was created on these social media platforms, Reddit, I think, and I'm honestly not familiar with the others, But basically now you have these retail investors just investing relatively small amounts of money, buying the stocks long, which drives the price up. And that eventually will result in a short squeeze where your institutional money managers that have the short positions are forced out, meaning they have to buy the stock back, which in turn drives the price even higher. And so you have these rapidly increasing stock prices with these companies where the fundamentals haven't changed at all. GameStop's business model, hasn't changed. AMC, BlackBerry, but yet the prices are up, 100%, 1,000%, and that certainly is not long-term investing. It is very much speculating, which we don't do. Chuck doesn't do that. And largely our clients and Chuck's clients are not affected because we don't own GameStop. We don't own AMC or BlackBerry. We saw the market sell off last week. And one reason could have been, these institutional big money with the short positions, when they have to turn around and buy the stock long and close out their shorts, to raise the cash to buy the stock, sometimes they have to sell other names in their portfolio. And those are names that are good names: Johnson & Johnson, Walmart, Kimberly-Clark, who knows? And so some of that selling activity likely drove the market lower. And that is what we were looking at last week.
Yeah, actually, I don't know if any of our clients owned any of the names that Hamp mentioned. If they did, it would have been one of about 7,000 different stock positions that they owned in our portfolios, and it would have been a very, very minor position. So whatever happens to GameStop, whatever it is, it won't even register on their portfolio.
Okay, does anyone else have any questions? No. Okay, well, thank you, Hamp. Thank you, Chuck. You gave us all a lot of great information to think about, and
You're very
really
welcome.
appreciate your time for the day.
Sure.
Want to remind everyone that our next meeting will be February 22nd, and it will be a virtual meeting. Our speaker will be Jared Williams, the new district attorney for Augusta. So you want to come out and hear what he has to say. And then I'm glad Jeff Aslan showed up, because today I have a joke rather than a thought for the week. And it is related to our topic as well. So the joke is, how do you know when it's time to retire? So I don't directly ask that question, so I'm going to answer that for you today. It is when you stop lying about your age and start bragging about it. So I thought that was cute. Thought that is pretty accurate. And as Chuck said, before you retire, make sure you have something you want to do in your retirement. So thanks to everyone. Have a great, safe week, and we will see you guys back on the 22nd, unless you want to go to the Division 6 rally tomorrow night at 7:30 and hang out with me and Lowell and Jeff Drake. If you do want to do that, send me an email. I'll be happy to send you that login information again. Everyone take care, and thanks again, Hamp and Chuck.
Thank you.
Bye, guys.